Hi everyone, welcome to Buzz Crimson. So in today's video, I wanted to talk about investments that you can make to protect yourself against a market crash. And why am I making this video now? It felt appropriate considering what's going on with the market. Everything is skyrocketing. Even companies that has no reason, it's got no reason to go up. They're going up. There's just too much money sitting around in people's pocket, and people are sitting at home, and they feel like trading, with their stimulus money. Maybe they're not traveling, shopping, all that stuff. They're just dumping money in the stock market. Stock market is the new gambling place because people can't go to the casino. That's how it feels like nowadays. So I think I'm someone who tries to trade no matter where the market is. I don't like to trade in one direction all the time. Why trade only for up and down? I even trade sideways for, that's where the iron condors or butterflies come in, right? But for stock market, bubble, I think inverse ETFs are an amazing tool for, catching some action. The reason why inverse ETFs are really looking really good right now is because pretty much all the good inverse ETFs are pretty much every week they're breaking their new 52-week low. They're so cheap that it's a no-brainer. I'm picking them up every time they're breaking their new 52-week low. So I wanted to share a list where you can see a lot of these inverse ETFs, and I'll show you a couple of them, but all of them essentially target a certain index, a market, maybe a sector, and there are leveraged ones. But understand that inverse ETFs, especially leveraged ones, are not long-term, are not good for long-term. So I'm picking them up because I believe there will be some sort of market adjustment in near future. So yeah, that's why I'm picking them up. So let's go. Let's see the list. All right, so this is the list of all the inverse ETFs that I generally keep track of. And as you can see from the columns, their prices are very low. They're all trading near their 52-week lows. And I have a column which is essentially percent to lowest, or 52-week low, you could say. So how much they need to drop in their share price to hit their 52-week low and essentially make a new 52-week low, right? So as you can see, pretty much all of them are very close to hitting their lowest of the year, at least for the trailing 12 months. And I think the only ones that are kind of high up there are probably the semiconductor ones. It's a very strong market. Semiconductor companies are very stable because they're just not like internet companies. But even then, I just feel like these companies, they're a bit overvalued. Some of them, not let's say AMD, not AMD, but most of the other ones, I think they're overvalued. So how do you invest in these and make profit, or what happens when the market adjusts itself? So let's go over an example. SPXS. Okay, so here's SPXS. As we can see, it's last 1 year. So this behaves the opposite of S&P 500, but it's a leveraged ETF. So it'll behave the opposite in the opposite direction of S&P 500, and it'll do that 3 times of what the S&P experienced. So there was a market crash right around February, March. Notice how around that time, when everything fell down, this went up. If you actually pull up S&P 500 chart, you're going to see that it's exactly opposite, but a little more not as steep because this is a 3x leverage. If you look at a non-leveraged inverse ETF for S&P 500, it'll be just like this, but not as extreme. So that's pretty much how inverse ETFs work. They just spike up when whatever it's betting against goes down. Simple as that. So it's really important for you to know what they're betting against so that you can choose and make your correct choice. Here is a column where I'm showing the 3 inverse ETFs that I have purchased, and I'm picking them up over time because I think they're very cheap to pick up right now, and worst case scenario, they're just going to go up a little bit time to time. I can always get rid of them at almost market value, whatever price I paid for, or a little less. If hypothetically, let's say, yeah, we will never see a bear market again, then okay, sure. I mean, worst case scenario, I mean, these stocks are so cheap that you won't feel bad about it. But if they do start climbing because of a market crash, you're going to be so happy that you purchased these inverse ETFs. So that's pretty much it for this video. I'm going to share the spreadsheet in the video description. Look out for a link. If you have any questions, leave it in the comment section, and please don't forget to subscribe. If you enjoyed the video, please subscribe. That really helps out my channel, and it motivates me to keep making these type of videos. All right, that is it. Thank you for watching.